Hello, welcome back. So in today's video, I'll be talking about why picking stocks is a mistake. So in today's video, I'll be covering a few things. We'll be covering why picking stocks is a mistake, Alibaba stock, as well as some questions that you guys have left me in the comment section below. So let's talk about why picking individual stocks is a bad idea. So the first theory that you guys might have heard of is something called efficient market hypothesis. So what it says is all stocks, they are priced at reasonable pricing, and so there's no loopholes and no inefficiencies when it comes to owning stocks in the market. Meaning to say stock prices go up for a reason and stock prices come down for a reason, and everything is reasonable in the stock market. So this is one of the arguments that economists make when it comes to owning stocks, and that is why they say that most individual investors, they can't beat the market because the markets, they are mostly efficient. The other reason why picking individual stocks is a bad idea is because for your ETFs, you have diversification. So you're spreading out your eggs into multiple baskets, which will reduce the risk of kicking yourself out of the game. So your ETFs, for example, your S&P 500 has 500 different companies inside. So just by buying one ETF, you're spreading your funds into 500 different companies, not equal weight of course, but it gives you more exposure and it helps you limit your risk of one company killing your returns. So the other reason why picking individual stocks is bad is simply because of the volatility and risk. So this is United Health. United Health over the past month is down around 50%. So you don't usually see this for your ETFs. In a bear market, the average drawdown is around 34%, whereas your individual stocks, they can easily fall 50, 60, 70%. And even a giant like United Health can fall around 50% from its highest pre-earnings to its current price today. And then the last one is just simply behavioral biases. So humans are all prone to biases, and it's hard for an investor to not chase hype stocks. So this is ARK Invest, for example. ARK Invest was talking about how everything is going to the moon, how Zoom was going to the moon in 2021. And since then, the fund is down around 60% from its highs, although it has recovered by around 30% in the past year already. So buying individual stock increases the risk of buying into hype stocks and chasing hype stocks if one doesn't have the ability to manage his own funds. So the statistic also shows that individual investors, they lose to the markets most of the times. So the average investor has around 2.1% return, whereas your S&P 500, they normally give between 8 and 10% returns annually. So this shows that your individual investors, they almost always vastly underperform the market, and that's why investing in an ETF is normally the better solution. So there are counter arguments to this as well. So one reason why people underperform the market is simply because the holding period is too short. So the holding period for stock has gone down from 7 years to currently now around 10 months, and I expect this to continue on and on and on for the foreseeable future because the markets are now driven by hype, the markets are now driven by trading activity, and there's something called a greater fool's theory whereby people buy stocks in hopes that someone else, a greater fool, will buy it out from them. And that leads to bubbles and all that as well. And that's why you're seeing the holding periods coming down substantially like this. But the problem with decreasing a holding period is this. When you decrease your holding period, what happens is you will cut your roots too quickly. So Buffett has previously said that he doesn't care about when he's right, he cares about whether or not he is right. But cutting your roots too soon will reduce the probability of that playing out. Meaning to say, if you trade in and out of your stocks very frequently, what happens is you won't be able to see the fruits coming up if it ever comes out. So years can happen in weeks, and not holding long enough will cut winners too short, and that is possibly one reason why individual investors, they normally can't win. The other counter argument to this as well is that concentration is normally the route to market beating returns. So this is Berkshire Hathaway's 1988 common stock portfolio, and as you can see, they have around 5 stocks here, and it is crazy concentration. So they have Capital Cities ABC at around 35% of their portfolio, Geico at around 27% of their portfolio, Coke at around 20%, Washington Post at around 11%, and then the Federal Home Loan Mortgage at around 4%. So they only have around 4 to 5 stocks in here, and this is the greatest investor of all time, concentrating significant amounts of money into just 5 stocks over here. So this is what Warren Buffett has said about concentration and diversification as well.
Charlie and I have been confident enough, if we were only running our own net worth, I'm certain a very significant number of times, if you go over 50 years, there have been a lot of times when you'd have put at least 75% of your net worth into an idea, aren't there, Charlie?
Well, but 75% of your worth outside Berkshire has never been a very significant amount.
Well, but I'm going back. Let's just assume it was. Let's just assume you didn't have Berkshire in the picture. There have been times, I mean, we've seen all kinds of ideas we would have put 75% of our net worth in.
Warren, there have been times in my life when I've had more than 100% of my net worth invested in things.
That's because you had a friendly banker, and I didn't. There have been times, well, initially I had several times I had 75% of my net worth in one situation. There are situations you will see over a long period of time. I mean, you will see things that it would be a mistake if you're working with smaller sums. It would be a mistake not to have half your net worth in. I mean, you really do sometimes in security see things that are lead pipe cinches, and you're not going to see them often, and they're not going to be talking about them on television or anything of the sort. But there will be some extraordinary things happen in a lifetime where you can put 75% of your net worth or something like that in a given situation. The problem has been the guys that have put 500% of their net worth in. I mean, I mean, if you look at, just take LTCM, very smart guys, very decent guys, some friends of mine, high grade, knew their business, but they put, maybe 25 times their net worth into things that were a cinch if they hadn't have gone in that heavily. I mean, they were in things that had to converge, but they didn't get to play out the hand. But if they'd had 100% of their net worth in them, it would have worked out fine. If they'd had 200% of their net worth in it, it would have worked out fine. But they instead went to, maybe 2,500% or something like that. So there are stocks. I mean, there's quite a few people in this room that have close to 100% of their net worth in Berkshire, and some of them had it for 40 or more years. Berkshire was not in the cinch category. It was in the strong probability category, I think. But
so Warren Buffett clearly believes in concentration. He's even willing to put 75% of his net worth into one single position. So as he said, concentration is normally the way for you to beat markets, and it is generally okay. But don't go overboard and leverage on your positions. That is when your concentration gets out of hand. So generally, if you see high quality businesses trading at very low or reasonable valuations, that is when you should be concentrating into those positions. Besides that, not all companies in the S&P 500 are equal quality. So there are only a select few companies that are high quality in the entire index, and buying ETFs spreads your funds into those low quality companies as well. So it ultimately depends on your returns to effort ratio. If you're enjoying researching and reading into stocks, then investing into individual stocks is the way to go. But for most investors, I think the best approach is simply just to put their money into the S&P 500. So this is what I'm doing. I have some of my money in ETFs, but the markets are generally overvalued at around 27 times earnings. That's not to say there aren't any opportunities elsewhere, and I don't think I'll be paying a 27 times earnings for the S&P 500 with low quality companies in it as well. Because not all your 500 companies in the S&P 500 are high quality, and so if I were to buy it for 27 times earnings, I'm paying a high multiple for those businesses as well. I'll buy the index when the index corrects to around 18 to 20 times earnings when it gets cheap again. That'll be where I'll be putting my funds in there. And I don't think buying an ETF is a bad decision for any given investor. Sometimes getting market returns is much better than trying to outsmart the market and trying to concentrate all your funds in a single decision. So next portion, I'll be talking about Alibaba stock. So Alibaba year to date is up around 30%. Currently now, the stock is trading at around 15 times earnings, and it is significantly higher than its 52-week low. So for Alibaba, there is one headwind for the business right now, which is the capex spend. So the management is significantly increasing the capex spend into AI infrastructure, and the only instant where they ramped up their capex spend was in 2021, and the ROIC dropped significantly that year as well. So that can be linked to the housing crash. So there isn't a very substantial evidence that shows that that management has executed well in terms of its capex spend. So I'm not too sure how this one will play out this time, but in China is digitalizing, growing, and transitioning to a way of life that is much higher quality for its locals. So it is moving away from a manufacturing dominant country to a country that is more reliant on its consumers, similar to what the US is. The Chinese government, they want to do that. They want to shift to a consumer-led economy, because a consumer-led economy increases the standard of living for its locals, and it will allow all these different consumer companies to grow massively as well. And one of them is Alibaba. Alibaba has around 41 to 42% of the market share of the e-commerce portion in China. Pinduoduo is around 17%. JD has around a 17% as well. So it's sort of like an oligopoly in China itself. And for Alibaba, it is one of the most durable brands in China. They're currently the leaders in the cloud computing space in China, with increased growth in that segment in China. There are clear tailwinds with stimulus checks that haven't taken into effect yet. So if you have to look at what the government has been doing, the government has been pushing stimulus checks to its consumers to make them spend more money so that they can revive the economy again, but that hasn't taken into effect yet. So once that one takes into effect, we could see a lot more returns and a lot more earnings growth in Alibaba, and the valuation is very sound for the business as well, currently around a 15 times earnings. So for Alibaba, this is my valuation for it. So assuming a 17 times multiple for this business and assuming a 10% earnings per share growth, so around an 8% earnings growth and a 2% buyback, which is very reasonable, which is also not taking into account the growth that they could see in the AI segment, this company will give you around a 13% CAGR at this price. So I think Alibaba is close to the buy territory already. If it continues falling over the next few months or so, I could see myself adding a very small position into Alibaba, a starter position. When it gets to around 15% CAGR, which is what I want with all my businesses, Alibaba is a quality stock in China. I think it is one of the companies in China that will greatly outperform if the conditions are right in China. So this is one I'm looking out for, and I'll be adding into this one if it drops to around $100 a share. Last portion, I'll be covering some of the questions that you guys have left me in the comment section. So the first one over here, it says, could you do an analysis on Spotify's business and its stock? I find it interesting as it is somewhat multi, kind of similar to Netflix growth path. So yes, Spotify is a company that is incredibly high quality, but the problem with the business is this: they don't own a lot of the music that they have on the platform. So a lot of the music and the podcasts that they have on their platform is owned by all your different music labels like Universal Music Group, Warner Brothers Music Group, and all your different other music labels. And so the problem with Spotify's business model is they are extremely thin margins. But for Spotify, I think it is a quality business. The only problem that I have with the business is the margin itself. So yes, it could be a similar growth path to Netflix. It is a very dominant player in your music space. The only competitors are YouTube Music as well as Apple Music, but I don't see those two coming in and taking Spotify's market share. Spotify's subscriber growth has been quite incredible over the past few years, and I expect this to continue over the next few years. But for Spotify, currently the valuation is a bit too steep. Even if you stick a 40 times multiple and a 30% EPS growth for this company, it still doesn't make sense at this price. I've been looking into this one, but I don't think I'll be investing into it anytime soon, just given the valuation itself. Next portion, what do you think about FICO's price drop? Nice video. So for FICO, the problem with the stock itself is it is simply just too overvalued. It is the language in your consumer credit rating portion in the US, but the problem is FICO is abusing its natural monopoly that was given to it by its government. So the FHFA previously regulated that FICO scores will be required in every single mortgage loan registration, but for FICO, what they've been doing over the past few years is they've been ramping up prices aggressively. So in nominal terms, the price increases are not very significant, but in percentage terms, the price increases have been simply just too remarkable. So this year alone, they increased their prices by 40%. So they increased from $3.50 for FICO score to around $5 per FICO score. So that's around a 40% increase in the prices itself. So for FICO, it's a quality business, but the problem is if you're too reliant on just price increases without much volume increase, then you could see regulators coming into your space and basically having scrutiny as well. So there was another company, VeriSign. VeriSign is a company with incredible pricing power to the point where regulators, they had to come in and stop VeriSign from increasing prices and regulate its ability to increase prices. And that's why a company like VeriSign is only able to increase its prices by around 5% or so, 7% in the last 4 years of its contract. And so FICO could see this problem coming up in the future as well if it continues with this aggressive ramp up in its prices itself. But of course, there are tailwinds with the business as well. The housing market in the US is in ruins right now. As soon as the Fed starts to cut rates, then you could see a lot more volume increase in terms of your credit rating portion, which will reduce the need for FICO to ramp up prices to increase earnings. So for FICO, I think at its current price, it is still very overvalued. Currently now, it is around a 70 times earnings. I would like for it to drop to around $1,400 a share. That will be around a 50 to 60 times earnings. And assuming a 20% EPS growth for this company, I think a 50 to 60 times earnings will be much reasonable as compared to its price today. So over the next few weeks, I expect more news to come in for FICO. I expect the stock to move on Bill Pute's comments, and let's see where this one goes. Last comment, what is the difference between MSCI, Moody's, and S&P Global? Are they all in the same industry? I never hear people talking about MSCI. So MSCI is similar to the indices portion in your S&P Global. So S&P Global, they own the S&P 500 index as well as your Dow Jones index. Whereas for MSCI, they own your emerging markets index as well as most of your world indices. So they're operating in sort of like an oligopoly. S&P Global with the S&P 500 is dominant in the US, whereas MSCI is dominant in every other country outside of the US itself. So for MSCI, it's a quality business. It is a compounder. They are incredibly asset light, and all they do is they just license out their index to all the different asset and fund managers, and the asset and fund managers will pay a fee to MSCI. I hope you guys have found this one useful and invest